really is the foundation to everything, business wise and investment wise. And what I view the tax system, how I view it is really just an incentive system that the government set up. So what the government wants to see, it wants to see more jobs in our economy, and it wants to see more affordable housing for its citizens. So as a real estate investor, what the tax code really is set up for is to provide you incentives for exactly what you're doing by, providing housing, to your citizens by being maybe an apartment complex owner, maybe you own some mobile home units, maybe you own just some small residential rentals. Those all fall into a category that the government's actually trying to offer you tax benefits for. So, that's one of the reasons why real estate really is one of the best asset classes. There's tons of reasons from a financial perspective that I know you cover on a lot, but there are a lot of tax benefits that go along with those financial benefits. So, one of the big ones that almost everybody's going to get to enjoy, obviously, is depreciation.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Patrick Camuso. Patrick is the founder of Camuso CPA out of Charlotte, North Carolina. Patrick is a certified public accountant, and he holds degrees in both accounting and finance from Montclair State University. Patrick, thank you so much for joining us on the show. And how are you doing, my friend?
Yeah, thanks a lot for having me on. I appreciate it. I'm doing great.
Absolutely. Yeah, we haven't touched, we touched on many financial strategies and some kind of bits and parts, but I would love to get you on as a CPA to kind of talk about it from like a high level overview, because we have such different type of listeners, from limited partners to active investors to all different types of asset classes. So, well, before we kind of dig a little bit deeper into that, for those who are not familiar with your background, would you mind sharing for a few moments your background, how you got started in finance industry?
Yeah, I guess I've spent, my whole career in the finance industry. I went to school for tax and for finance and accounting. I interned and then I worked at Deloitte for about 5.5 to 6 years. So that's where I started my career and built up the bulk of my career. And, then I started Camuso CPA, where I've been consulting mainly to real estate investors and construction companies, other types of investors and small businesses now for a little over 3 years. So I focus very much on actually working with real estate investors. And I know, you were just mentioning that you have a wide variety of listeners. Some may be in commercial, some may be involved in multifamily, some may be doing other types of investments. Maybe you have some investors that are, just starting out with building their portfolio. And, just like with my clients, I work with a wide variety of real estate investors as well. So I see a lot of those different scenarios that, some of your viewers may be seeing as well.
Yeah, a lot of people kind of talk about the many benefits of real estate, as far as kind of like owning a physical asset. But can you kind of talk about the benefits from a tax perspective? And because I get a lot of questions like that, but I would like to kind of kick it to a CPA to kind of let them know what the true benefits are outside of just earning, passive income and, owning a property.
Yeah, well, with the tax code really is, I know nobody really likes taxes, and taxes and accounting maybe isn't the sexiest subject, and maybe it's not going to get you the most views, but it really is the foundation to everything, business wise and investment wise. And what I view the tax system, how I view it is really just an incentive system that the government set up. So what the government wants to see, it wants to see more jobs in our economy, and it wants to see more affordable housing for its citizens. So as a real estate investor, what the tax code really is set up for is to provide you incentives for exactly what you're doing by, providing housing, to your citizens by being maybe an apartment complex owner, maybe you own some mobile home units, maybe, you own just some small residential rentals. Those all fall into a category that the government's actually trying to offer you tax benefits for. So, that's one of the reasons why real estate really is one of the best asset classes. There's tons of reasons from a financial perspective that I know you cover on a lot, but there are a lot of tax benefits that go along with those financial benefits. So, one of the big ones that almost everybody's going to get to enjoy, obviously, is depreciation. So, that's a big one from a tax perspective. And there's a lot of even the more advanced tax strategies that we look at center around accelerating depreciation on your properties. And all depreciation is a non-cash deduction that's based on the value of the property that you purchase. So that's one of the biggest benefits to being an investor is, you can purchase a property and you can use leverage to purchase a property. And for whatever price you purchase that property for, you can take it to a prorated deduction for the fair market value of that property for each year that you own it. So, maybe you buy a $5 million property, you take that $5 million property, we divide that by 39 and a half years, and you get this deduction against the income that that property is making for you each year that it's in service. So right there, you're getting, a tax deduction that doesn't require an out-of-pocket expense from you. And, you're going to use that as tax deduction on your tax return. So that's the first benefit that it offers. Now, there's a lot of other benefits that get a little more situational that also come into being a real estate investor. So obviously, anytime you buy and sell real estate, there's a lot of opportunities in the tax code that allow you to accelerate your wealth building, where, maybe we use something called a like-kind exchange to defer the taxes that you have to pay on the capital gains on a property that you sold. And by using strategies like a like-kind exchange, or maybe an opportunity zone fund, or maybe, another type of tax strategy that maybe applies to your portfolio that allows you to defer paying capital gains. In a scenario like that, we're able to take money that we would be paying the IRS and take that money, keep it in your portfolio, go and purchase more properties and get a return on this money that would have went to the IRS. So, you have depreciation, which is a benefit that's built into anybody that's owning a property. There's ways to accelerate that depreciation potentially depending on the size of the property, the type of property that you own. Then, as you're a real estate investor, there's additional tax deductions that you can start taking when you sell your properties to defer paying taxes to accelerate the growth of your property. Those are two of the big ones. And then, depending on the nature of your portfolio while you're owning the properties, there's also tax deductions that you're going to be able to take from a business perspective, depending on if your real estate portfolio gets treated as a business or not. So, there's a lot of benefits that come into just basic tax deductions, travel, meals, things of that perspective. So you can capture a lot of those benefits as a real estate investor as well. So that's why, like you said, you hear people very often touting the tax benefits to being a real estate investor, because they are somewhat situational. We can get into some of those situations, but there are many, many tax benefits. But the biggest one that I think that when people are saying that is the depreciation, and that, you can make thousands of dollars in income and have thousands of dollars in the depreciation deduction, and that can net to zero or even pass through a loss for you.
Wow. Yeah. I mean, yeah, that's definitely the most common that we hear about when people are kind of talking about it, especially from a active and passive investor perspective. Can you kind of note some kind of these items? I know, like insurance premiums, management costs. Is there a couple other items that are typical? I know you probably can get a little bit deeper. And then you had mentioned a whole bunch of stuff, and maybe we can talk about those separately as well. But can we talk about some of the items that people can depreciate, say, for example, on a multifamily property?
Yeah. So, in terms of items that you can expense, anything that has a business connection and is spent on the business and is ordinary and necessary to the business, most likely will be able to get deducted. And that's usually what I would tell my clients. That's a good rule of thumb. Now, obviously, there are categories that we usually see that are getting expensed. Anytime you're spending on management fees, like you said, anytime you're paying for legal fees to a CPA or legal fees to a lawyer, or you're paying fees to a CPA or any other type of professional, anytime you're paying marketing fees, those are all easily expensed. Now, the other thing you mentioned, depreciation. Once you start getting into depreciation, like I was saying, this is one of the big benefits to being a real estate investor is depreciation. It's a non-cash deduction that you're able to take on your tax return. So, that's going to get depreciated over a certain schedule or amount of years, depending on the type of property that you own. But if you're making a lot of repairs, there's the opportunity to, depending on the type of repairs, have a CPA take a look at the type of repairs that you're making, document those appropriately. You may be able to take a repair that you did for however much it was, and rather than depreciating that over 27 or 39 years, depreciate that over 5 years, or take the full expense in the first year and get even a bigger deduction for that year. So you always want, anytime you're looking at repairs, you want to look at those individually, especially if they're a significant repair, and see the best way that you're able to take that. Because one of the big changes with the Tax Cuts and Jobs Act that just got passed not too long ago is any asset that's going to have a depreciation life less than 20 years, most likely we're going to be able to take that as that full depreciation expense in the first year. So what that means is most repairs that you're making are going to fall into that category, and if it's to your benefit, we can deduct those in the first year. So anytime you're making repairs, you want to look at those as a completely separate thing and see, how should these be getting booked from a depreciation perspective? Because there's a lot of opportunity to actually accelerate your depreciation there. And now, if you're sitting on, a large multifamily apartment complex, a large commercial property, even a large mobile home park, that's when, maybe the opportunity of a cost segregation comes into play as well, where maybe you haven't made significant repairs, but maybe you just purchased a property, and we can actually have engineers run a study to look at all the various components to the underlying property. And then that allows us to do the same thing, come in and put all those different components on the tax return separately and accelerate the depreciation deduction on those, to where maybe you were taking something over 39 years, we take it all in the first year, or we take it over 5 years, things like that. So, what all your regular business expenses most likely are going to be able to get deducted. And then we want to take a much harder look at your repairs. But when it comes to your regular expenses, any type of professional expense, broker fees, advertising expenses, property taxes, all management fees, all those types of fees are also deductible.
And then you mentioned possibly spreading it over 5 years. So say if you had a project where you kind of was going to do certain repairs year one, certain repairs year two, is that what you mean as far as kind of be able to, or do you have to?
Well, yeah, I mean, anytime we're looking at optimizing depreciation for someone, we want to do just that. We want to optimize. So a lot of times when we start talking about depreciation, people just start thinking, let me accelerate my depreciation as much as possible. But sometimes it does make sense to maybe not take the full cost of a component of your property in the first year, because based off of a 5-year tax projection, it's to your tax benefit to retain some of that tax benefit for year 2 or year 3.
Exactly,
So that planning definitely comes into play. Anytime I'm looking at a tax plan with someone, we're always taking a multi-year perspective for that reason. So that definitely needs to get taken into consideration, like what's your overall goals with the property in terms of how long do you want to hold it for, and what other properties are you purchasing in the future, and just what's your overall tax position year to year. That's going to impact exactly how we want to depreciate the components of that property.
Perfect. Yeah, that kind of answers my question, because I was like, say if you had like a business plan of holding a property between 3 and 5 years, we can work with you to say, guy, this is the plan. What's the best way to kind of optimize the tax position here?
And then what a lot of people like to do there, in terms of like holding a property for a few years is, if you can purchase like a bigger multifamily property, or other types of property as well, purchase that, run a cost segregation on it, accelerate all your depreciation. Most of that benefit you're going to eat up in the first few years. You run that cost segregation, you get this huge tax benefit. Then after the first few years of maximizing that tax benefit, you could turn around and sell that property Now it's going to have a lower cost basis now, remember, because we did a cost segregation.
Right.
But you turn around and you sell that property and do a like-kind exchange, and you can defer paying the capital gains on that property, and then you get another property, and you can basically rinse and repeat, and you can use that strategy basically in perpetuity, even to the extent of just doing that forever, basically. And then if once you passed away and you pass those properties to your heirs, they would get a step up in basis on those properties, so they wouldn't have to ever pay tax on those capital gains either. So it comes into understanding sort of how do you accelerate depreciation. In terms of tax planning, comes down to understanding sort of what are the benefits to being a real estate investor, and then how do you maximize some of those benefits in terms of accelerating your depreciation, using strategies to defer your capital gains, ensuring your tax deductions are maximized, and then trying to combine all of those, with the long-term perspective from a multi-year standpoint. And that's really how you're able to sort of achieve the best tax planning outcome from my perspective.
I don't know if you had mentioned it, but the term phantom loss, can you kind of explain that and kind of what that is? That has to do with the depreciation as
You
well?
said, yeah, phantom loss. I've heard that term a couple times. Basically, what it means from my perspective is, yeah, it's a loss that you didn't incur out of pocket. So maybe at the end of the year you get a K1, or you're preparing, depending on how it's structured. You may be getting K1, you may just be preparing your tax return on your Schedule E. However it's getting done, but at the end of the year, the property had maybe let's say, like, let's just take a really simple example. Let's say it had 20K in income for the year, and it had 10K in expenses. And when I say expenses, I mean management fees, marketing expenses, accounting fees, legal fees, etc., etc. So then it's at 10K net profit. But then now you got to remember, we were just talking about depreciation. Depreciation is an expense that's not going to cost the owner of this property anything, right? And let's say, for this example, remember, we're at 10K net profit. Let's say depreciation is 15K. Now for tax reporting purposes, that property is at a 5K loss. Really, it's at a 10K net profit, but for tax reporting, it shows a 5K loss. So in that scenario, now all of the income that you made off that property is tax-free because of depreciation. And now you might be able to also take that 5K and use it as a tax benefit against other properties, against other income. Now there becomes a whole nother tax planning scenario that goes into using passive losses. And we can discuss that too. But yeah, that's like where the phantom loss comes from, is basically those non-cash tax deductions shielding income from being taxed, and that can sometimes lead to an actual loss.
Okay, great. As far as kind of from a syndicator, operator, sponsor perspective, is there any benefits or pros and cons of using single purpose LLCs compared to like C corps or anything, or is it LLC is probably the best bet on a tax purposes basis?
You're saying for a syndicator specifically?
Yeah. So like, holding the entity, is there any like, differences or anything, or is there one that you prefer?
Usually, if you're going to syndicate a deal, it's usually going to be with a multi-entity structure if you're managing the properties. Now, for the entities that are holding the properties, usually I see those as LLCs, whether they're single member LLCs, multi-member LLCs. It's going to depend on the entity and the property. But that's usually where the properties are held in an LLC. You can do a series of LLCs that are held by one partnership that holds all the other LLCs. That's very common. And then usually, you may see an S corporation as the management portion that gets a management fee from the main operating partnership. C corporations have their place in a tax plan. Most likely, if you have a real estate portfolio, you're not going to be utilizing those in most scenarios. So I think it's safest to probably assume you're going to be using an LLC, and possibly, along with that, maybe an S corporation. And that's usually the most common structure, I say.
Awesome. And as far as kind of like a limited partners, any reason for say if a passive investor has 100K for them to set up an LLC to invest into the single purpose LLC, or they should just be able to invest normally, straight directly, as a part owner of that one purpose LLC?
I don't really see any issue with them investing directly. Now they may want to set up an LLC and have the name on that K1 that's getting their allocable share of the income and expenses from that partnership, rather than it being their name and social. It can be their LLC and it can be their EIN.
Mm-hmm.
And then to whatever degree this would also limit their liability into from that perspective. Right. From a tax perspective, it's really not going to have a large impact though.
Okay, cool. And it's kind of of course, talking with you before they maybe get into an investment or start a partnership, what's kind of like some of the processes, and do you have any kind of success stories of some investors that you worked with in the past that kind of, went down that road?
In terms of just, so you're saying like two investors come to us and they're looking to start a partnership for real estate?
What will be kind of like the first thing for them to start, and that you would recommend for them to kind of get ready to do?
So anytime someone's coming to me from that perspective, I definitely want to make sure that they're also roping in legal advisors as well. So where I'm really providing advice and services to people is on tax planning, tax preparation, and then on accounting for your property and company level expenses. And then I can provide other business level services as well, possibly help you try to improve the profitability on some of your properties. But when you're in this early startup phase on starting a partnership, I definitely want legal roped in as well, because there's a lot of liability considerations with that. We're going to have to start some companies up with you, and that's best done with the legal advisor. So I do have people reach out to me at this stage. That would be one of my first recommendations. After that, I would want to discuss what your plan is with the partnership, and try to understand what type of properties it is that you're buying. Try to understand what each partner's bringing to the table in terms of their economic contributions and what the equity split within the company is going to be. And when you're getting started, that's one area that I may be able to help advise around a little bit on the financial side of things, is how that's going to get set up and how that's going to impact you from a tax perspective. But when you're first getting started, what you really need from me is going to be pretty limited, because where I'm able to help you is minimizing taxes and putting accounting systems in place. So I want to make sure that you have a good legal team and that you're taking the right preliminary steps to get an LLC in place, and that you understand sort of what I'm looking for from a financial perspective with your accounting and with your taxes in the future. But really the area that I can assist with there is making sure that you're making the financial considerations with how the company is going to get allocated on the K1s with those partners. And then where I get involved more in the future is, depending on what your plans are for the portfolio, we may look at doing some tax planning right up front to make sure everything's efficient, for this entity, if you're going to be aggressively purchasing properties. Or, we may hold off and may do that a little bit later once you purchase a property or two, depending on, what your portfolio looks like. And then obviously down the road, we'd want to get you set up with accounting systems as well. But, that's a little bit down the road a little bit. So when you're working up front, it's really about getting your entity structure in place, making sure all of your company documents are in place as well, such as your operating agreement, things of that nature. That's more legal based, although you definitely want to be having this conversation with me, keeping me looped in, and just having me sort of identify, hey, maybe we should have a conversation here or there, and just making sure everything's on track.
Beautiful. Yeah. Thank you for that. I forgot to ask it before, because we kind of got a little bit deeper in the other stuff regarding opportunity zones.
Yep.
That is not something I'm very well versed in. So I want you, if you could be able to explain that for the audience, and maybe the tax benefits on that as well.
Yeah, so the tax benefits with opportunity zones are huge, and it's like you said, maybe you haven't heard too much about it, and maybe a lot of people haven't heard too much about it just because it is a new element with the 2018 Tax Cuts and Jobs Act, so it hasn't been around all too long. And since then, people have really been wrapping their heads around it. There's been series of clarifications from the IRS on some of the detailed rules around it. So it's a fairly new element of the tax code. For those out there that are sort of familiar with like kind exchanges, it functions somewhat, it'll sort of resemble that to you, some of the features of this. But basically, opportunity zones are a tool that we can use, sort of going back to our earlier conversation. It's a tool that we can use to defer paying capital gains on, properties or anything else that we may have sold as investors. And then there's some other benefits that come with opportunity zone funds. So that's at a high level what it can do. So basically, the Treasury designated locations all throughout the United States. There's thousands of them. Doesn't matter what state you're in. There's some in your state. We would have to do research and determine exactly like what exact zip codes and areas in your state qualify as opportunity zone funds, but they're in your state. So the Treasury designated thousands of these areas as opportunity zones. So basically, any investments that go into these opportunity zones through what's called an opportunity zone fund, which is a partnership that you would have to set up, that would have to operate within that state, within that area. You're able to, invest funds into into an opportunity zone fund that operates within an opportunity zone. And whatever funds you invest in that, they're going to be capital gains funds. So say you have $1 million in capital gains, you can invest that $1 million into an opportunity zone fund, and for as long as that money stays in the opportunity zone fund, you do not have to pay tax on that $1 million in capital gains.
Mm-hmm.
And now, if you keep and that's one of the benefits in opportunity zone fund. Now, if you keep the funds in the opportunity zone fund for 5 to 7 years, you'll be able to reduce that $1 million by 5 to 10%. So rather than paying tax on the full million in 5 to 7 years, you would pay tax on 90 to 95% of that in 5 to 7 years. So that's benefit number 2. Now the third benefit is that while the funds are in the opportunity zone fund, you may, let's say, make another $200K of capital gains within the fund. And if you stay invested in that fund for 10 years, all those capital gains are forgiven. So the big element to it, and there's a lot of details that come to an opportunity zone fund, much like kind exchanges. Like, you have to invest the funds within 180 days. And if you're operating an opportunity zone fund, there's a lot of requirements that come with it that are probably too detailed for this conversation, that I do help people out with. I can definitely help somebody out with, and we can have other conversations about. But at the big level, like what an opportunity zone fund does for someone that's investing in it is you're gonna get that upfront tax deferral. So think about it, that million in hypothetical gains, you would have had to pay tax on that to the IRS. Now you're able to get a return on that for 5 to 7 years, and then pay tax 5 to 7 years from now in the future, and then possibly get partial forgiveness on some of that gain, and then any gains within the fund you get full forgiveness on. So it's just a way to defer paying taxes and get partial forgiveness. But from that perspective, it's a very powerful tool.
Yeah, I know that definitely another probably podcast for another day there. But you mentioned the opportunity zone fund, so that's created by like a sponsor organizing this and then getting exchange funds from other investors in there, or you kind of can set it up for yourself, or I mean, like, how do one set one up, like just on a basic level?
Yeah, like there can be very large opportunity zone funds or very small ones. At the most basic level, it would still be called an opportunity zone fund in the eyes of the IRS if it's a partnership with 2 or 3 people in it and it's operating in an opportunity zone. So that's like that's like the simplest opportunity zone I can give you. But the more likely it's going to be a larger syndication. But they can be as simple as a two-person partnership that's meeting all the qualifications of an opportunity zone fund.
Is one of those qualifications like doing improvements to a property within that zone?
Yep. The biggest qualification I would say is that you have to is the timing and the fact that you have to do significant improvements to the property. So if you have to buy a property, you're going to have to do significant improvements up to certain thresholds on that property.
Gotcha.
That's one. You're also going to have to take the capital that's in the Opportunity Zone Fund and invest it within a certain time period. That's number two. And number three is, there's going to be a higher compliance cost to managing an Opportunity Zone Fund. So those are probably the three biggest hurdles to starting one.
And then there's like, I'm assuming, because you mentioned requirements. So is that financial requirements on top of the own cash that's going into the actual investment itself, to kind of anything that goes to the IRS as far as kind of administrative fees or
when I say
stuff?
Compliance requirements, I mean, for instance, like there's the requirements to make significant improvements onto the properties.
Oh, okay.
So it requires on the accounting side of things, we take certain measures to create an audit trail that shows that a certain amount of money has went to making improvements on the properties and making sure that those get allocated to the partners correctly. So it just increases the cost to your accounting. Then when you get to your tax preparation, there's additional forms that you're going to have to file to certify that you're an Opportunity Zone Fund. Mm-hmm. It's specific elections that you're going to have to make. So it's going to increase your filing costs from that perspective. So that's what I say when, it's going to increase. There's going to be additional compliance costs to make sure that you're just working within the rule set that the IRS has outlined, not necessarily that there's fees that you have to pay to IRS.
Gotcha. And are they still finalizing the details of this? Because like when I started to kind of research a little bit, it just seems still kind of grayish area, and it was kind of hard to answer any general questions on it. Do you know if they're coming to some type of conclusion as far as like what the rule is? Because I know that they have like a certain time frame that they wanted to implement this for.
Yeah, not too long ago, there has been some further clarification provided. So, I there's enough out there now that we're able to put some plans together.
Gotcha.
I do expect more to come in the future. But for now, I do think that we have enough to work with, and probably from when you were researching it, there's probably been some additional releases of information.
Oh, beautiful. Okay, yeah, like I said, that's definitely a very interesting topic that's come up in some of the discussions with the investors.
Yeah, one other thing I'll add to that too, just at like a high level, is a lot of times people are looking to maybe use that as a substitute for a like-kind exchange on just the investor side, not on starting a fund, but on the investor side. If you're pursuing a like-kind exchange, you're in that 180-day window. The like-kind exchange falls through. As long as you're still within that 180 days, maybe there's an Opportunity Zone Fund available to you to help you still defer those capital gains. So, it could be a good fallback option from that perspective as well.
Even after the 45-day identification period, or?
Well, the way that would look is you'd first be pursuing a like-kind exchange. So we would have went through the 45-day identification period. We'd be on the 180-day clock, and maybe your properties fell through for whatever.
Gotcha.
So now you're hung out to dry, but maybe we can still look at an Opportunity Zone Fund, still get that capital gains deferral.
Oh, sounds good. Perfect. Yeah. So just kind of learn a little bit more about you and kind of like your routine. Do you have a typical, what's like what a typical day for you, and then kind of do you have any special morning routines?
Yeah. I mean, I do try to have, I guess, like, just a very basic sort of morning routine. I guess I do like the first 30 minutes or so that I get up. But it's basically just, like 20 minutes of stretching. I have like a small home gym in my garage. That's usually where I'll do that. Usually take maybe like 5 minutes just to clear my head and sort of have no thoughts for a little bit. Then I'll usually do about 30 minutes of reading. I'll try to read like within that 30 minutes, usually 2 separate books that I'll be trying to read at the same time, just like on different subjects. So, I'll spend like 15, 20 minutes on one book and then switch the books up. And then from there, just make sure I start to hydrate and just supplement myself properly. Just according to the regimen that I have set up. And that's basically it. Like after that, I feel pretty charged up, and I usually start my day by, going to my office. I have a home office that I'm doing this with you on here right now that I work out of some days during the week. And then I have an office here in Uptown Charlotte that I go to many days out of the week. So, depending on where I'm going to be that day, that's I'll either head out to the office or I'll head upstairs, and, I'll sort of start my day from there. And my day is really, a mix of client service, providing content / marketing for the firm, and doing actual client work, and putting together tax plans, tax preparation, things like that. So my day's pretty varied, but I like to take that first 30 minutes to try to get a good start, and but I try to keep it simple too.
All right, sounds good. Yeah, like I said, a lot of similarities that me and you have. What
Yeah.
are you most grateful for?
Well, I'm grateful for a lot of things. I think I live a pretty good life, but I am expecting my first son here later in the year here this
Nice,
year. So I
congratulations.
think that would probably top the list for this year.
Nice, very
Yeah.
nice. Cool. So how do we get in touch with you?
So the best way to get in touch with me would be to visit my website, CamusoCPA.com, and then if you visit the contact us page there, my firm's phone number, my email, that's all on there. You can either email me or you can call me at 704-249-3179. And that's the best way to get scheduled. I offer free initial consultations, so we can have a conversation about your portfolio and or your business, and make sure that we're both a good fit to work together. And then also on the website at CamusoCPA.com, there's a ton of content on there, a ton of real estate related content on there. That's all free, value added tax and accounting advice. So definitely check that out too.
Thanks. Great. And that's CAMUSOCPA.com.
Yes, sir.
Perfect. All right. Patrick, it was great speak with you. Again, it was I appreciate you kind of doing it from the 30,000 foot level. I know you can get really deep into this, and like I said, maybe we can turn into another podcast on specific topics. Because like I said, this is very important topic as a real estate investor, and something that we at least be cognizant of and know who to go to as far as kind of getting advice from. So again, I really appreciate you. Have an enjoyable week, and look forward to connecting with you again soon.
Likewise, I appreciate it. Thanks for having me on.
Take care.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.